Steve here. Look, the 4 p.m. bell just rang, and man, it brought another cold bucket of reality for the Hope trade. Seriously, while the retail crowd spent the entire day trying to buy the intraday dips, staring at their screens, praying for a pivot, the big money was busy distributing risk right into the close. We're going to walk through this explainer of the day's action, and we'll uncover what the hard data is actually telling us. No fluff, just the facts.
Now, I want this next thought burned into your mind. You cannot trade a structural energy war with a zero interest rate playbook. The equity market is finally, violently waking up to this fact. For a decade, every dip was a buying opportunity fueled by cheap money, right? Well, that era is over. The big money knows it. They're offloading risk while amateurs try to catch falling knives. If you're still using strategies from 2019 to trade today's tape, you're going to get wiped out, period.
All right, quick look at the agenda. 1. The Tuesday close. 2. The yield trap. 3. Geopolitical brinkmanship. 4. The sentiment divide. And 5. Your trading directive. Let's get right into it.
Section 1. The Tuesday close, the morning ledger. The bleeding continued today for a third straight session. Let's look at the actual prints.
Here's the verified reality of the Tuesday close. The S&P 500 shed another 49 points to finish at 7,353. The bulls really tried to mount an afternoon defense to save that 7,400 shelf, but technical gravity dragged the print straight into the red. We broke decisively below that psychological anchor. And Brent crude? It's sitting at $111.10. Ease slightly off its overnight high is sure, but make no mistake, it is locked in a structural bull flag well above pre-war levels. Gold is heavy at $1,494, breaking support as real yields climb. And Bitcoin, man toxic, clinging to $76,981 after violently snapping its near-term support floor. The numbers just do not lie.
Moving on. Section 2. The yield trap. Stagflationary math. The fixed income desk is screaming a warning right now that equity traders are just barely starting to hear. That whole soft landing narrative in math? Yeah, it's dead. It officially collided with stagflationary math. 4.60%. That's where the 10-year Treasury yield settled, deep in enemy territory. Why are we here? Well, following last week's scorched 6% PPI print and a really sticky 3.8% CPI, institutional desks aren't just thinking higher for longer anymore. Actually, they are actively pricing in the probability of an actual rate hike under Kevin Warsh's new Fed regime to forcefully break the back of this energy-driven inflation. And for anyone holding high multiple tech growth names, this yield is pure poison, the kind that doesn't come with an antidote. When the risk-free rate moves this high, equity risk premiums must expand and multiples have to compress. It's basic, inescapable mathematics.
And then you have this beast of a number, a brutal 43% year-over-year spike in energy costs. If you dig into the underlying consumer data, it confirms that nominal spending stability is a total phantom. Real volume is down. Every single extra dollar of consumer capital is being chewed up by this exact spike, with the national average for a gallon of gas holding firm at $4.53. This is just draining real consumer demand straight from the bottom up.
Section 3. Geopolitical brinkmanship, the Strait of Hormuz. We really need to understand the gravity of what's happening on the water right now.
Look, do not confuse a temporary pause in military action with an actual resolution. Right now, on the water, conditions are locked down tight. Tehran has moved forward with his newly minted Persian Gulf Strait Authority. They're attempting to collect arbitrary transit fees and trying to enforce sovereign veto power over Western commercial and military vessels. Guys, this isn't just political posturing. This is a restricted tanker traffic situation through the Strait of Hormuz, severely disrupting a route that normally carries 20% of the global oil trade. The White House might be temporarily holding execution orders for kinetic strikes to let back-channel diplomats talk, but the physical flow of energy, it is blockaded right now.
But here is the core leverage point the smart money is tracking: the power plant leverage. See, Iran is facing an organic 25,000 megawatt structural deficit on its physical grid, and that's before the peak summer heat even hits. This gives the diplomatic weight an exceptionally tight expiration date. The Pentagon's military apparatus is fully spun up. If this new tolling body continues to block commerce, or if threats turn kinetic, the executive option to execute strikes and turn Iran's domestic grid completely dark, that goes right back to the center of the desk.
Okay, Section 4. Sentiment analysis, the divide. This brings us to the two fiercely competing narratives in the market right now.
You've got a massive disconnect happening out there. On one side, you have the naive, retail-driven earnings rescue camp. They're basically betting that corporate earnings from mega-cap tech later this week will deliver some growth miracle massive enough to spark a short squeeze. Maybe they think a tech CEO is going to pull a rabbit out of a hat. But the bond market isn't buying magic tricks. They're completely ignoring the bond market warning sirens. On the flip side, you have the institutional reality, the stagflation spiral. They know cumulative global oil inventory drawdowns have already surpassed 1 billion barrels since hostilities began. If the diplomatic track fails, reserves run dry, Brent crude shoots to $150 a barrel, and you get widespread equity capitulation. Those are the two sides of the tape right now.
Section 5, the Trading Directive. Professional advice. Listen to me. Turn off the television. Stop listening to the pundits. Pull up your 1-hour charts and lock your focus on the tape. Here is your battle plan for the Wednesday Open.
Looking at the S&P 500 ES contract, yesterday we tested the lower bounds down to 7,333 before a minor late bounce. Your job today is to watch the 7,330 shelf. If the S&P futures break below 7,330 on volume today and spend 2 consecutive hourly prints underneath it, the technical breakdown is confirmed. If that happens, focus entirely on shorting the overextended technology rallies. Do not try to catch the falling knife. Trade the breakdown.
Next, pull up the BZ contract. Brent at $111.10 is your true North Star right now. Keep your eyes glued to this chart. If crude ticks past $113, it means the institutional desks know the diplomatic talks are collapsing. I'll repeat this because it's absolutely critical. Do not buy dips in growth equities while energy is rising. It is a fatal error in this stagflationary environment.
Now, if you don't want to play the futures, follow the architectural lead of the smartest money in the room. Look at this number, $397 billion. That is the massive cash pile Greg Abel and Berkshire are sitting on. They are holding this cash for a reason, folks. They are earning a guaranteed 5% risk-free yield. That is the dominant macro trade right now. Getting paid a risk-free 5% while you wait for over-leveraged corporate structures to capsize under the weight of these higher rates and compressed multiples.
I'm going to leave you with this question for the Wednesday Open. Are you trading on hope, or are you disciplined enough to trade the reality of the morning bell? Keep your sizes small, keep your stops tight. The market doesn't wait for latecomers. Stay disciplined, watch your averages, and I will see you at the morning bell.